Well, welcome to this episode of Navigate, podcast dedicated to middle market companies and their owners to look at practical solutions for business and tax issues worldwide. So we're going to start today with a very special guest, Kalen McDonald. He is with the firm S&C Partners out of Mississauga, Canada, and we're going to talk about what he sees as issues and opportunities in Canada. So, with that said, welcome.
Morning, Jim. Great to be with you here today.
Well, we really appreciate it. And so, Kalen, I think one of the things that we see here in the States is obviously our neighbors to the north, and there is a lot of trade, a lot of activity between our two countries. What is your impression from the Canadian side in doing business with the US? What are some of the things that you would recommend up front before stepping onto Canadian soil that Americans stop and think about?
Yeah, great question. Very often, Canadians think about the gateway to North America being through Canada as opposed to the US. And I think one of the reasons for that is that we have an increased range of tax treaties with countries around the world, which I think number kind of 96 today. And I kind of recollect that maybe the US has 78 treaties. So there's a few more countries protected by tax treaties with Canada. And we also have, I think, more free trade agreements with countries around the world. So I often think about, Canada being a potentially slightly friendlier neighbor in North America for companies that are looking to coming into the North American space. So, that being said, there's also a lot, going for Canada in terms of being part of, the G7 and the G20 and the World Trade Organization and the OECD. So, we play ball with all of those, trade organizations and representations. We are also, the city of Toronto, where I live, is the fourth largest city in North America, kind of the last time I checked. So it's kind of has about a population of 3 million people. And we often talk about Toronto, but then we talk about the greater Toronto area, which, I think numbers as many as 8 million people. And the neat thing about the greater Toronto area is it's about a 2-hour drive from land borders with the United States of America. And so we are a market, ostensibly north of the border in Canada, but, populous and fairly close to commute to for Americans. So that's a couple of things, that come to mind. What else about Canada? I think we have, common law that's been passed down to us through the Commonwealth and through, the United Kingdom. We also have investor protections, and we have, low corruption, things that I also know and expect in the United States of America, as well as a very highly educated workforce that are capable and skilled, and world-class universities, like my alma mater, the University of Waterloo, and McGill University in Montreal, where my daughter is studying as we speak.
Oh, good. So, when you think about industries in Canada, what is Canada best known for?
Yeah, probably best, known for having, I think the world's third largest proven oil reserves, and those largely live out west, right, in our provincial in their provinces, Alberta and Saskatchewan. So I think the world does see Canada as being a resource-intensive country, and we are, and some of that is challenged at present because we have a federal government that is really keen to meet some climate change goals in 2050, and so some of that development is, I don't want to say stalled, but under pressure. And so I think that's kind of one resources. I think two, construction and real estate. Toronto has more cranes in the sky than any city in North America at present. I think the crane count is still more than 200. And what's being constructed is a lot of residential condominium towers, as well as some commercial towers. And we've seen that the commercial space has been adversely impacted by the pandemic and the changing norms around going to work. But so I say, but construction would continue to be a big industry that's going on, in Canada. And then when I think about the firm and the clients that we represent, we have so many clients is now in the service business, and those can be professionals, lawyers and doctors and dentists and so on. But they could also be, organizations that assist with nursing or personal support workers, any number of industries in the service industry. So those are kind of the big three that we see here.
And Toronto, is that not a major tech center for Canada?
Yeah, it would be, right. So that's I don't know that the rest of Canadians appreciate this, but we kind of look at Canada as being, as Toronto as being the center of Canada, and I think that it is the financial capital of Canada. It does have a lot of tech businesses and tech industries, and a lot of those are supported west of the city from the University of Waterloo and other hubs that have been built and developed around the tech space. You might have recalled a company called Research in Motion that kind of developed the BlackBerry, and is now kind of still around in different forms, but the tech space would be headquartered largely out of Toronto, and not disparage my friends in Montreal, but I know they have a tech sector there that they're trying to develop too.
If we look at Canada overall, if you think about the provinces, can you quickly give us a quick rundown on what you see as the business activities in those various provinces?
Yeah, so I talked about let's see if I can work my way west to east, kind of across Canada. So British Columbia, again, resource intensive, lumber. They would harvest lumber. Tourism would be spectacular. They would also have famous universities, the University of British Columbia, out there. Moving over the mountains into Alberta and Saskatchewan, the oil and gas business, I think a lot of people think that that's headquartered out of Calgary, which was probably the financial center. The oil and the harvesting and so on of the oil sands happens north of Calgary. So some say that that's maybe closer to Edmonton, and others might argue that's probably north and beyond into the oil basin from up there. So that's kind of Alberta, Saskatchewan. Manitoba, I don't know that I have a lot to say about Manitoba, not to disparage my friends in Manitoba. And then we move into the big province of Ontario. And then most of our populace in Ontario, like I said, is down towards, between the big lakes, close to Lake Ontario and Lake Erie. And tech construction is going on here. There are resource development opportunities in Northern Ontario too. There's the province is trying to develop the Ring of Fire, which my understanding is includes some naturally occurring elements that are integral to producing batteries, which I think we can all agree that the world needs more batteries. Continuing to move east, we get into Quebec, and we have the big cities there of Montreal and Quebec City. The only walled city in North America with a 400-year history. And if you haven't been there, everybody should see Quebec City. They too would have resource industries, and Montreal's a burgeoning tech center, and again, world-class universities, like I mentioned previously. Then as you get out into the maritime provinces, I don't know that I have a whole lot to add, but we have New Brunswick and Newfoundland and Labrador and Nova Scotia, and these are very pretty places to visit. I think tourism probably continues to be pretty big out there, and our friends on the island of Prince Edward Island too have beautiful beaches and golf courses, and again, industries, for decades, relied on fishing kind of out east, and I think that's changing. And the development of hydroelectric power happens in their maritime in Quebec. And I think a lot of that power too was resold to our friends in neighboring New York State. So that's a source of, I guess, emissions-free power generation.
Yeah, I think a lot of our potential clients, they look at the process, and it's, where do I settle first? Do I need to be in Montreal? Do I need to be in Vancouver, in Toronto? Where do I need to be? And then the very next question is how do I get there? what's the right vehicle that I should use or consider using, knowing how the U.S. has the corporations and limited liabilities companies and partnerships. What do you see on the Canadian side as far as entity construction for companies coming into Canada?
So I think corporations are the most popular structure, and like the U.S. and other countries, we have partnership law, and we have trusts, and so that would be another type of third structure. We have some provinces, not all, but some provinces that have unlimited liability companies. And so, oftentimes we see our friends coming up from the United States forming ULCs, unlimited liability companies, in the province of British Columbia or Nova Scotia. And I think those companies help a US taxpayer that's used to how the LLC rules work in the United States. And so that, I would say, the inbound structure is probably the most common, is an American parent, forming a ULC in one of those jurisdictions, and then choosing to operate where their skilled workforce is probably, going to be found. And I think that would typically be the major urban centers in Canada: Toronto, Vancouver, Calgary, Montreal.
And so how does a Canadian ULC work with the U.S. as far as our treaty with Canada? Are there any issues there?
So my understanding, and I don't hold myself out as a cross-border expert, but the income from the Canadian ULC flows through into an LLC with a full tax credit for taxes paid in Canada. So that Canadian ULC would pay a rate of corporate tax, and that's probably 26.5%. And there'd be two components to that element of corporate tax. There would be a federal tax, federal payable to Canada. And then there would be a provincial tax, and the provincial tax would be levied where the business has been carried on. And very often, like 26.5% is the rate that you would find here in Ontario. And they would be comparable, probably plus or minus 2% across the different provinces and territories across Canada. So if you were to set up in Vancouver in British Columbia, it might be plus or minus 2 points in terms of corporate tax rate on the income earned by a foreign-owned corporation.
So from an entity construction perspective, what are 2 or 3 things that you upfront tell clients that they need to think about in deciding ULC, corporation, trust, partnership? What are those items from a Canadian tax perspective that you suggest that Americans, individuals or corporations coming to Canada, what should they be thinking of?
Not forming a Canadian corporation and coming over the border as a foreign entity, could expose you to branch tax, and that is a complex regime with filings. Sending employees from the U.S. to carry on business in Canada, could create Regulation 105 issues in terms of, there must be withholding paid for those employees. So I think the absolute simplest thing to do is to form a corporation, and then to decide who to own it. I think one of the challenges that any foreign, company coming into Canada has is, well, we got to establish a banking relationship. And now you have non-resident directors often, right, that are forming these companies, and so setting up banking is, I'll call it, a small hurdle, and then it's not dissimilar from a Canadian, trying to expand into the United States and creating a U.S. entity and getting banking in the U.S. Sometimes there's not even, business numbers or social security numbers. They just don't exist, and that often just confuses a form. So I think banking's a challenge. And then payroll is different across every province and territory, and the amount of withholdings for an employee workforce that's going to be established. And all of the provinces and territories would have a workers' compensation or workplace safety and insurance board consideration too. And some of the provinces like Ontario would have an employer health tax that would levy a tax based on the gross payroll of a corporation, depending on where the employees report, and that could be around 2% in the province of Ontario on payroll in excess of $1 million.
Well, you mentioned Reg 105, and this is one of the items that I know we deal with quite a bit with Americans sending employees to work in Canada, and they don't really stop to think about it. They think the borders are blurred, and so they just send Americans over to work in Canada. What is the process in dealing with Reg 105, and what should an American employer think about when sending someone across the border to work in Canada?
I think it starts with maybe one of the basic tenets of Canadian tax law, and that's residency. And Canada taxes individuals and corporations based on residency. If you're here, you got to file and you got to pay. And that's not, sometimes determining where you are resident is a difficult thing, right? So maybe you've been seconded from your US operation up to Toronto for some period of time. And while here in Toronto, you've established a few things, like you've rented an apartment or a condominium. Maybe you've got an Ontario driver's license. Maybe you got some healthcare coverage that's being provided by your employer. And so then, residency is kind of a tie-breaking process. Is, what ties do you have to Canada, requiring the individual in this case to file a Canadian tax return, versus perhaps where you came from, in the United States. And so it's figuring out those tiebreaker rules. So, and I think, countries around the world, including Canada, they want to, and I guess I should also preface that too with, the Canadian tax system is heavily reliant on personal tax revenues. And so personal tax revenues are garnered largely from salaries. And so, so getting that right, getting the residency right of an employee seconded to Canada is I think important. And so I think what we encourage companies to set up payroll services from the outset before the employees land in Canada, so that it's agreed on what that employee is going to be paid, where the payroll deductions are going to be remitted, and then how he or she is going to report his income personally.
Is there any type of exemption system, anything that an American would want to apply for with Revenue Canada to reduce the withholding? Is there any opportunities such as that?
Jim, I'm not aware of any. We have these forms called TD1 forms that reduce withholding, but they usually reduce the withholding for tax preference items, like I'm making retirement savings contributions, or I have a large family of dependents that I'm supporting, and so on. But I don't think so is my answer.
So when you have this is something that we see all the time. So we have a U.S. company. They do not have an entity in Canada. They're sending employees to Canada to work. Aside from Reg 105, what is the major issues that they need to be aware of by having people, their employees, working in Canada for the company, the U.S. company? Major implications.
I think those employees are going to have a Canadian compliance burden, and I think very often the foreign companies help those employees with that personal tax filing in Canada, for example. And I know that the United States, for example, has a foreign earned income exclusion if that American is coming into Canada and earning a salary from his or her efforts working on a job. A large portion of that could potentially be exempted from tax in the U.S. And I also understand that the United States tax based on citizenship, so, and not residency. So that U.S. person seconded to Canada is going to have to file in the U.S. in any event, and for as long as they're on the planet, I guess. But so I think getting that personal tax item right, I think is critical for the employee.
But from the corporate side, where is that bright line where they now have a tax obligation to Canada?
I don't know that I can answer that question, Jim. I don't know how definitive I can be on that. I think, are you looking for a guideline maybe in terms of time? Like, I sent someone up to Canada to work on a project for 2 weeks and I brought them back. Is that kind of where you're going, or?
Yeah.
Yeah.
I think it's more of, okay, I'm working on a construction contract and I'm going to be there for 10 months. Yeah. Is that enough for the Canadian government to come in and say, under our treaty, you have a permanent establishment and now you're going to have an obligation to Canada?
I don't know. I don't know the answer to that question, Jim.
Yeah, it's very fluid because it really depends upon the facts. Is what I'm driving at. So
Yeah,
don't
it does. It does.
yeah, you don't want to make an assumption that this is what it's going to be. So up front, it's very important in reviewing the process of going into Canada. You really need to share up front, not just with an American advisor, but with a Canadian advisor, so that they can together determine whether you do have a permanent establishment. And if you do, what does that mean? From a compliance perspective, what is the timing of returns? What are some of the major returns that people may want to have in the back of their mind to consider in doing business in Canada?
Corporations file an annual corporate tax return called a T2, and that T2 corporate income tax return that would be due 6 months after the fiscal year end. So if you're a December 31st year end, you would need to file that by the end of June. So we find the month of June to be pretty busy in our office getting those things filed. Taxes are due a little earlier, and they're due. The balance due day is technically 2 months after your year end. So again, in my example of a December year end, you'd have till the end of February, to pay those taxes. And then we would have an installment regime, and the assumption would be that your corporate tax liability from the prior year would be repeated, in the next year, and that you would make monthly installments against that filing. So the other concept that Americans might not be used to is that we don't have extensions for anything. A filing deadline is a filing deadline. So that's the corporate. A personal and individual would file based on a calendar year, and his tax return or her tax return would be due April 30th typically. And then if that individual had self-employment income, there's a way to extend that to June 15. And again, a person would have a quarterly installment obligation for tax if not enough taxes are withheld at source. So those would be the primary, tax filings that you would see. And then the Canadian personal tax return is a T1. And now that I'm thinking about it, and the Canadian reliance on personal tax revenues, that's why it's T1, and a corporate tax return is a T2.
Instead, is in Canada, are there credits, special deduction regimes that are available for Americans to use if they're conducting business in Canada?
Yes, I mean, I think how tax is computed in Canada is federal legislation that forms the Income Tax Act, and normally the starting point is income determined under accounting frameworks, and that accounting framework is probably accounting standards for private enterprises, for our medium sized entities. As well as international financial reporting standards that we also have here in Canada, IFRS. So that becomes the starting point as we compute income, following an accounting framework, and then that income is adjusted to the tax rules on Schedule 1 of a corporate tax return. And you'll see some deductions, like say meals and entertainment, restricted to 50% of that amount. You'll see things like employer-provided automobiles, or the depreciation on an automobile might be restricted, for example. You have other expenses like life insurance that may not be deductible, for Canadian taxes. So there are, and the Income Tax Act now spans 2 volumes, lots of rules of what may or may not be deductible and how you compute taxable income.
Well, you mentioned something. You touched on something, that being transfer pricing. So how does Canada address transfer pricing? A lot of the conflicts that we see with clients doing business in Canada, where there's these cross-border transactions, you see a lot of issues with how Revenue Canada versus the US may view these things. Can you touch on transfer pricing and why it's important to establish some form of documentation upfront?
Yeah, I mean, I think the Canadian expectation is that there is contemporaneous documentation of transfer pricing across the border, and that is disclosed annually to the Canadian Revenue Agency as part of that corporate tax filing regime on a form T106 that highlights the transactions with non-residents and the transfer pricing methodology selected for transacting, with those entities. So I think there's an annual declaration and sign off that this is how we are accounting and tracking things and effectively pricing things. So I think it is key and it is critical. And my experience, almost 30 years dealing with the Canada Revenue Agency, is that documentation wins the war. And so very often when clients start to increase the amount of trade across borders, we do encourage them to get transfer pricing studies so that we are protected. I would also say that when you look at the tax rates, Canada versus US, they're not entirely different. If I understand kind of a federal rate of 21% plus a provincial rate on top, that's not dissimilar from the amounts that I shared previously with you of about 26.5% in Ontario. So there's not a huge advantage to in putting income in Canada or US. I guess I'm saying there's not a huge bias to reporting more income in one jurisdiction versus the other.
So, Kaylin, we appreciate the information you've given us today. Let's shift gears here to one item that perplexes most Americans, and that is the Canadian GST system. How does that system work, and then how to get goods into Canada? So, do you mind educating us on that system?
Happy to talk about that. So, you referenced the GST system, that stands for Goods and Services Tax, and it's aptly named because it applies to most things, most goods and most services. So there's a limited number of exclusions, but suffice to say, it applies to most things. And the national rate of the GST is 5%. And so that is across all, like I said, most goods and services across Canada. And then you have to look at the individual province to understand, does that province have their own sales tax regime? And there's two that come to mind quickly that do, like British Columbia has their own sales tax, which I think is 6 or 7%. So that would be on top of the goods and services tax, or the province of Quebec, which I think is like 7.75%. So they have their own sales tax regime. And then there's a whole number of what we call harmonized provinces, like the province of Ontario, where Toronto is headquartered, and where I live, where the HST rate, the harmonized sales tax rate, is 13%. And again, that 13% applies to like most, goods and services. So you're buying a car, you're paying HST. Paying for accounting services, you're paying HST at 13%. You're getting your haircut, you're paying 13% HST. So that's what we have. So we have a national framework of 5%, and then you got to look at the province where you're operating. And if you're a harmonized sales tax province, that's pretty straightforward. And if you're not, then you probably have, if you're operating in a non-harmonized province, you have a separate registration and a separate sales tax collecting regime. And then the sales tax often works is the rate is levied dependent on the jurisdiction where the goods or the services are delivered. So if you're an Ontario company and you're selling goods and services into the province of British Columbia, there's a very high chance that you should be registered for the British Columbia sales tax, even though you're based out of Ontario. And so your sales tax regime is somewhat complex in that you're charging 13% to your goods and services in Ontario, but then when you're moving across the country and delivering goods or services into another province, that you might also trip up on another sales tax registration. So the goods and services tax puts a lot of money into federal coffers because, like I said, it applies to most things. And I'm still confounded why the Americans to the south of us don't have a national sales tax. But I also understand that the GOP doesn't like tax to start with. So bringing in something national and across the country is probably difficult. Although, from a Canadian perspective too, it's difficult to understand the U.S. sales taxes that exist in each of your states, including city taxes, which we don't have. City taxes aren't really a thing in Canada.
So is there anything that an American company importing or exporting into Canada, is there anything they need to be aware of as far as getting product across the Canadian border?
Yeah, so you have to. So when a company sources products from outside of Canada, a GST tax is levied at the border, and so sometimes those are dealt with customs or clearing houses when those and they collect the sales tax when those goods enter the border. And then the way that the sales tax regime works is you report, let's an example of a good that you sold for $100 in Ontario, you would collect 13% sales tax, $13 in my example, from your Ontario customer. And if those goods were imported for say $50 at the border, that company likely paid a 5% GST because these are federal coming into the border. And so they have something called an input tax credit, and that input tax credit would be 5% of, or $2.50 on the good coming in. And so on a regular basis, the sales tax regime would report the $13 collected against the $2.50 that was paid at the border, and they would remit the net amount. So it's a netting system. We know what we're collecting from our customers, and we know what we are paying on our business inputs.
So for anybody exporting from the U.S. into Canada, they need to be aware of what these costs are up front, or they'll be in a detriment as far as what they thought their profit would be.
Yeah, I could absolutely, and that they could be so if they did not comply with an HST regime, right? So delivering goods and services into Canada, and then I see with online retailers too, like Amazon, like they seem to be a lot better at getting that figured out for non-resident suppliers of goods and services, and that they're helping to facilitate the collection of the GST or the HST in a harmonized province. But yeah, it is something that you need to be super considerate for. And that also goes to, maybe if we're going to be doing significant volumes of business in Canada, we should form our own Canadian company that can be the importer of record and then can be the sales collecting agent on behalf of that entity. So I think if you have more than $6 million of annual revenue, there's a monthly sales tax reporting required, and if your revenues are less, it could be as little as once a year annually, and then again back on an installment regime, likely quarterly after that. So, but sales taxes, we're not unlike Europe that has a lot of value added tax or VAT. We are a higher sales tax jurisdiction, and that does put a lot of money into the federal government of Canada, and does require a lot of compliance, right? So potentially a monthly or quarterly filing in the sales tax area, and then multi-jurisdictional depending on where your customers are.
Let's real quickly touch base on Revenue Canada and audits. The IRS is very active down here in the States, and I'm sure you have the same situation in Canada. What are some of the more common items that are brought up for both corporate and individual audits?
Yeah, so number one that comes to my automotive expenses. I was looking at something this morning for a client, and a lot of what we see now, I tell our clients, you should expect to be audited once every 10 years. I think once every year, you will have a fulsome corporate tax audit. An auditor will come to your business location. There will be an extensive interviewing process. There will be a detailed review of your general ledger. Receipts will need to be pulled. And usually that corporate tax audit might also look at that goods and services tax or sales tax at the same time. So I think once every 10 years is the expectation. I think some of that timetable has been affected by the pandemic, and I haven't seen a lot of audits on corporate tax bases, going on post-pandemic. What I do see is we see a lot of post-assessing reviews, and so that's a letter often from the Canada Revenue Agency saying, we're looking at through your 2021 tax year, and you deducted automotive expenses of, X dollars. Please support that expense. And so that might be pulling a general ledger, pulling some supporting invoices and summarizing those and sharing those with the CRA. So I'm seeing a lot of that post-assessing review. In the automotive area, I find that's maybe not as well attended to or documented as well as for a lot of clients. I've only really seen mileage logs prepared under duress when required to support a tax deduction, but that type of thing. So I think that's easy pickings for the Canada Revenue Agency. I think meals and entertainment expenses too. They, sports tickets, golf expense. No part of a golf fee or a green fee is a deductible expense. So you see some of those kind of discretionary items often at the top of the list of things that the Canada Revenue Agency is going to look like. But again, I think, the issue I was looking at this morning for the automotive expenses for a client for the 2021 year, like we prepared a 25, 26 page submission, and I think that will be reviewed and probably be fine, and with no adjustment required. And that'll take 4 to 6 weeks probably for the Canada Revenue Agency to turn that around and respond to us.
So are there any thresholds they're looking at, or it's, hey, it could be a small amount, and they may just be checking to see if you have the documentation in place?
They are, and so that the examples I gave you were largely in a corporate context, but even in a personal context, a person can deduct business expenses for carrying on his or her business, and some of those might be pursuant to their employment, and so often those expenses are also audited too. So there's no guidelines. What I think my gut feel is it's the percentage change in the number year over year might trip a letter and a query that goes out to a customer. So I think if you have wide ranging, so example, if you had automotive expenses of 10,000 jumped up to 40,000 back to 10,000, I think that range of variability might trigger an audit. And sometimes there's just special projects by the Canada Revenue Agency that are based on a Canadian postal code, zip code in the US, where say, let's look at this little area and see what we can find out.
Do you find them to be the revenue agents to be cooperative, or is it more animosity between the taxpayer and the Revenue Canada?
I don't think there's a lot of animus there. I think they are doing their job. I think for most, business owners, entrepreneurs, they're an inconvenience, right? They're not going to help drive the top line or bottom line income. So there's something to be complied with. So we have that natural kind of juxtaposition of interest to start with. I think my complaint in the last number of years would be that there's been a lot of turnover in the Canada Revenue Agency, and there are a lot of new trainees. And so that affects their service offering. And when you're training people on the job, sometimes it just takes longer, or more information is requested, and potentially more than needs to be provided. So I'm sure the IRS has the similar issues.
We mirror that, and so we spend a lot of time training IRS agents on lots of different issues.
On live files, yeah.
Live files. So let's finish up with this. When you look at disclosures in Canada, so for example, in the US, we've had a number of rules regarding foreign bank account reports and delinquent filings for international in particular. What about Canada? How's Canada addressing these kind of issues?
Yeah, I think we've been taking a lead from the US and the IRS in that regard, and that we disclose more things now than we ever used to. And one thing top of mind is trusts. If you had a Canadian trust that didn't have any income to report, it would just not file. That's changing in 2023, and so now there's a disclosure of a Canadian trust, even if that trust has zero or little income. And along with that is the trust form must now disclose the names, identities, dates of birth, social insurance numbers in Canada of the trustees and all of the beneficiaries. So that's an increased disclosure. And you might form a trust and not know who all your beneficiaries are today, or they might change by the minute depending on when grandchildren arrive on the scene, right? So very often a Canadian trust agreement might also contemplate corporations that may be formed in the future. So you may not know with certainty what your beneficiaries are. So that's one thing in the trust area, and that's been around for 2 years and extended, but I think it's gonna happen in calendar year 2023. We've also had, on the corporate front, we have a revised, T1134 form, and that's an information return for controlled and non-controlled foreign affiliates. And that is a cumbersome kind of 12 to 14 page form that gets you to disclose a lot of details about your foreign affiliate. So it could be a US subsidiary, for example, what the book value of the stock is, what the value of the transactions are between the Canadian entity and that entity. So we're seeing a lot more, more robust disclosure in that area. And then something kind of brand new last year is the Canadian government is concerned about not having enough residential housing for its citizens, and so we now have this underused housing tax regime, which is additional reporting for non-person owned residential properties. So my wife and I, for example, we own a rental property, and we do that in the form of a partnership. And so both partners need to file an annual form disclosing that they have a residential property in the form of a partnership. And then there are exclusions from paying tax. But if that property was otherwise vacant, there would be a tax, levied on the partners in that circumstance. But there's a lot of exclusions there, and you got to find the right one. Like you had a tenant and you collected rent from him or her. So, but that affects partnerships, that affects corporations, that affects trusts, that affects bare trustees. So there's a whole bunch of forms that we help clients, file for the calendar year 2022, and these were originally due at October 31st, and then the government on October 31st actually extended the deadline till next April, which would be the natural deadline for filing these things. So I guess two things happened there. One, they figured out they couldn't keep up with the volume, and two, they didn't. A lot of people didn't know that they had to comply with this new regime. And that also ties into the city of Toronto, which has their own vacant home tax regime, because the city of Toronto wants homes available for people to live in, and that's a whole other filing that's outside of the tax system, really, but with the city system. So those, yeah.
It goes back to your comment about the number of cranes.
Back to the comment about the number of cranes. Yeah. And I think there's been some abuse in that area too, and that there's been some condominium flipping. And so that's where, people have deposits on condominiums and they transfer them from one building to the next build without a lot of reporting. And I think that's been cracked down on significantly too. Because like I said, that there's lots of building that continues to go on in the city of Toronto, and gosh darn it, we need it. We need more housing.
Well, I appreciate your insights, but I'd like to finish this with you telling us what S&C Partners can do for clients. How can you help our clients achieve their goals?
We like to think of S+C Partners as a full service, accounting firm. And the way that we hold ourselves out to the market is that we have the technical expertise and the business acumen of a larger CPA firm, but with the personalized touch and partner level attention of a boutique firm. So, our firm is in the city of Mississauga, which has a population of 800,000 people, and we are immediately adjacent or to the west of the city of Toronto, which again has 2.8 million people. So we're part of a large market, and so we do consider ourselves a Toronto-based firm. And anybody that's flown into Toronto will know that you are landing in Mississauga, because that's where Lester B. Pearson Airport is, YYZ. So that's who we are. And when I say full service, taxation is a big part of our service offering, and we have more than 20 team members of our total 75-person headcount that are dedicated to tax. Audit and accounting would probably be our next biggest practice area. And we also dabble in a couple other areas, which is information technology, infrastructure solutions, and human resource consulting. So, thinking about your clientele and your client base, potentially coming up from the US, we have a full service offering to help those businesses get established, comply with human resource regulations, register for payroll services. We don't form companies, but we can tell you who to talk to go and form a company. And then we can talk about what is the right jurisdiction for you to form that company, and should you consider one of the provinces with a ULC and unlimited liability regime. And I guess I should also comment too that we only work with successful growing companies, right? And those have to be privately owned. So if you are big and public, we are not interested in servicing you because we can't, because we are a boutique firm and we are focused on the entrepreneur and the private business owner.
I appreciate that. I think that's good for our viewers to understand that with S plus C partners, that you can provide that one-stop shop to help them figure out how to best navigate the waters in Canada. So with that said, Kaylin, again, thank you for your time today. We will be sharing this with our viewers, along with your firm information, and encouraging them to reach out to you directly if they need some help. So with that said, thank you again for your time, and we will meet you on the next episode.
Look forward to that, Jim. Thanks for speaking with me today. Be well. Bye-bye.